is yours.
Awesome. So I appreciate the introduction there, and I'm gonna jump around a little bit. We've got Bruce is gonna be running the PowerPoint. Don't get bogged down with that stuff on the PowerPoint slides. I'm gonna feel free to chime in if you have like immediate questions or want some clarification on points. Like I don't want this to be just me chatting the entire time, talking to myself, going crazy. So feel free to throw questions in the comment section, or just raise your hand and we can address that as it is. But to kind of set the stage here for what we're talking about seed stage financing. So, I mean, that's all relative nowadays, right? I mean, what's seed? What's pre-seed? What does that even mean? What is seed? So we're basically talking about raising money in order to fund your business. And so, Bruce, you want to roll with me to the beginning there? We can obviously not legal advice. And I'm going to kind of set the stage here with an example, which is an easy way for me to kind of get the tone set on this. Or the stage set. So again, we're talking about how we're going to fund our business. We have a great idea. We have maybe a breakthrough technology. Maybe we have a breakthrough business model, and we need to get it out in the marketplace. So maybe we need to hire people. We need to hire developers. We need to pay for marketing. We need to form the company. We have all the stuff that we need to do in order to bring it to fruition. And so generally speaking, unless we have some type of self-funding vehicle, we have a lot of capital on hand, we're going to need to find some way to fund this or to finance this. And generally speaking, for small startup businesses, banks aren't lending money. They're just not going to lend money on traditional way that you might see it for an existing business or an established business, or how we usually get it. So generally founders are left to either just use their own cash or like max out credit cards or raise capital from outside investors. And so I'm going to set the stage here with an example of a company. Let's say, you're busy all the time and you're working from home. You've got a bunch of kids. You're just working all the time. And you realize, hey, I don't have any time to wash my clothes. Like, why can't I just jump on like an Uber type app or some type of delivery service app and have somebody come over to my house, pick up my laundry, and I can leave it out in front of the door. They can go to their house, they can make some cash, use their laundry machine, and they can drop it off, get dry cleaning, all this stuff. So I want to start an app that does that. I don't have a ton of development skills. I mean, I can make a website and some things like that and design a logo, but I need to hire a developer. So I've created my business plan. I've realized, okay, well, developers, they want equity and they want quite a bit of money. I think just to get this thing off the ground, I'm going to need $500,000 to pay this developer, to form the company, to get registered, all these things. So how am I going to finance this company? And so usually what founders do is they go to friends and family and angels. And angels are usually just wealthy entrepreneurs or wealthy individuals that invest in startups, invest in venture capital type transactions. Sometimes you'll see these like linked to like an accelerator program. Sometimes they'll be linked to like an incubator, or sometimes they're just kind of known in the community. You might connect through like a business development center or something like that. So that's kind of the stage of our company. So we're going to talk about the different options that are going to come available and how this process gets started. So generally speaking, this process gets started by you going and meeting with these angels and finding out, hey, I'm trying to raise, let's say $1 million, $500,000 to fund my business. Here's my business plan. Here's my pitch deck. Here's where I think my company is going to be worth. Here's what I'm going to use the money for. And this is where I think the company is going to be. This is the niche that it fits. And at some point in time, once you've spoken with enough potential investors, you're going to come up with a term sheet. And the term sheet doesn't need to necessarily be this legal document. Sometimes it's just back of the napkin, right? Someone's like, okay, well, I'll give you $250,000 with this term and this term and this term, and that's the term sheet. But once you start getting involved in angels with angel investors or folks who are sophisticated in how this thing works and how the venture capital community works, the term sheet does kind of follow a certain protocol. And so we're going to talk about the protocol, the structure, some of the key terms. And I know we had a little bit of a little bubble there for pre-seed, but I'm going to cover a wide range of seed financing. So I'm going to talk about pre-seed, seed, and then a little bit of Series A. And generally, the type of way that you invest this money and the amount of money that you invest and what the investor gets correlates with that stage. So a pre-seed basically is the thought that it's just a smaller amount of capital without any equity immediately, that is like just enough to kind of get a minimal product out there, an MVP. A seed company is kind of something that helps you take that thing that's more advanced past the MVP and kind of take it out to market. And then Series A is kind of growth money to kind of grow the money, expand, start bringing in revenue, things like that. And everything is different. If you're in biotech, life science, the numbers are going to look much bigger at seed stage or pre-seed stage or any stage, and the expectation of revenue is going to be just lower because it's just the nature of that industry. So the term sheet, it's going to basically be back of the napkin type setup. We're going to demystify some of the terms that you'll see there. You're going to see some kind of tricks that you'll hear about from investors, and kind of how you push back and what you look at. We're going to go over the economic and non-economic terms, and we're going to help you avoid surprises. So common seed stage structures, convertible debt, okay? Convertible equity and priced equity. I'm going to go ahead and say 3. Priced equity is something that that's something that's usually going to see in a Series A. We're going to save that to the end. It's got its own complexities. I'm not going to spend a ton of time on that. I'm going to focus on convertibles, convertible notes, convertible instruments. So what is a convertible? What does that mean? What is going on? Again, kind of what we envision with our company is I need to raise some money to hire some developers. I have no clue. I don't have any revenue. I don't even really have a product. I've got an idea. I've researched it. I can't find anybody who's willing to pick up my laundry. I've got somebody across the street that told me that they would love to pick up someone's laundry on an app and do laundry, as a part-time gig. I know that there's a market, but I don't have any revenue. So I can't really tell you what the value of my business is. And so I've spoken with some investors and some wealthy individuals, and they're like, this is brilliant. This is going to be huge. I want to give you my money. I have a couple friends, and we're going to come in and give you the $1 million that you're looking for. Okay, so what's next? Well, what's next is kind of structuring that. A lot of times those early stage investors, they don't know what the value of your business is, and neither do you. No one really knows at this point. It's just an idea. So they're going to want an instrument that helps them protects their downside and also gives them the upside in it. So they don't want to put a value on your company yet. They just want to kind of give you what's kind of supposed to be debt, but with an upside of equity. And so that's what convertibles are. Generally, there's 2 different types of convertibles. There's convertible notes, which are promissory notes. They're debt instruments. So the promise to give you $1 million at 5% interest, that's paid in 5 years. That's pretty basic. The difference between a convertible note and a SAFE, it's a simple agreement for future equity, is how Y Combinator's kind of come up with it, is that there's no principal debt that's owed. There's no interest and there's no maturity date. It's basically the promise that I'm going to give you this money today, and in the future, it's going to convert into something else. So we're going to talk about that next, is what it's going to convert into.
Shane, before we move on, how would you decide, leading your laundry company, whether to use a SAFE or convertible note? And is that decision on you or the investor?
Yeah, this is a great point. I really appreciate it, Bruce. So this is going to be a negotiation point. So this is kind of where the level of sophistication might change, and some of it's due to kind of where you're located, where you're trying to raise money. Just generally speaking, if your investors are in New York, DC, out west, and a lot of parts of Texas as well, they are going to know what a safe is, generally speaking. You might not hear that in Tennessee as much or in the Southeast as much. You're gonna, they might not be aware of what that is. So that's just one hurdle. The other hurdle is what's better. So for a founder, you're probably better off going with the safe, right? Because there's no interest that's going to accrue. There's no maturity date that's looming. It's a little bit more of undefined. From an investor standpoint, the principal and interest is, we'll talk about the purpose of a convertible, but let's just say that the purpose of a convertible is not necessarily to get your payments of your debt back. Those investors aren't looking for periodic payments. They're looking to convert their debt into equity at a cheaper price. So that's kind of what they're looking for, but still the interest does accumulate and it does allow them to get a little bit of an upside. And there's a little bit more of a timing point of view from the maturity date. There's a little bit more pressure on the founder to kind of get things rolling and to reach that next milestone. And debt's also, it's a little bit more of a kind of understood, right? Like everybody knows what a promissory note is. Now, what's a safe? There's a little bit less of understanding of what that is. So generally speaking, an investor is going to want to be in a convertible note, and an entrepreneur is going to want to be in a safe, but it's push and pull. It's going to be a negotiation point. This is where the term sheet gets started. That's the big first point on the term sheet is what's the security that's going to be sold or issued. Okay, so conversion events. This is going to give you basically what you need to know about what an investor wants when they're giving you convertible instruments. Again, they could just give you a pure loan, but an investor, you don't have any cash flow. Like, how are you going to pay my interest back? You're basically going to use my money and pay me back with my own money. I mean, there's just really not much there for it. And, if you go belly up, I mean, you're probably going to blow through that money. You're not going to have really very much assets. So an investor wants convertible notes. They want some type of convertible instrument. And what that means is that upon the happening of certain events, we're going to run through 3 of them, that debt or that amount of money that they gave you is going to convert into stock, into equity at some point in the future. So there's generally 3 things. There's definitely 3 events that trigger this conversion. The first one is called the next equity financing, sometimes called a qualified equity financing. This basically says, hey, when you raise your Series A, when you sell priced equity, when a bigger investor comes down the road and they say to you, hey, your company we're going to buy preferred stock from your company for $1 million at a $5 million valuation, you can price the shares. You can know how much that's going to be, like how much per share are they buying your company for. They put a price on your company. They valued your company. So once that happens, we now have a base point to convert our debt that we were granted in the past into equity to buy stock, because we know what the purchase price is, we know how much we've already given you, and we know what it's going to be in the future. So you're going to see in here in the slides, NEF, maybe QEF. That's a next equity financing. That just means I've raised my Series A. I think we have a question right here real quick. So if the company fails, what happens if the company fails? It's unsecured debt. So it's not secured by any assets. And it's also, you shouldn't be signing a personal guarantee on this. If you're doing that, you need to walk away because the investor doesn't know kind of how the market works. You shouldn't be guaranteeing it. So if you go belly up and the convertible notes, then and you don't have any assets, then you're basically insolvent and bankruptcy, and the investor's probably not getting their money back. But no, you're not personally on the hook to repay it. So that was the next equity financing. Again, just think of a Series A, selling shares of your stock, of preferred stock in your company for X dollars per share. You're going to get a valuation. A change of control. This is you sold your company before you got to that preferred stock round. Somebody's bought your company. Someone, Uber saw what we were doing with our business, and they're like, "Oh, we should get in the laundry business. Let's buy you for $10 million." Boom. What happens with those convertible securities? So there's two things that can generally happen. They can generally get their money back, right? Depending on the price, they can get their money back, which is the principal and the interest if it's a note, or the safe, just the amount that was loaned. Or it can convert to stock. And usually you build in kind of like a baseline valuation so you know where it converts to. What the investor is going to choose to do in that situation is the one that's going to give them the most money. It's up to the investor to make that decision. Maturity, this is for debt only. This is another conversion event. Basically, if you've reached that 5-year period and you haven't raised money or you haven't sold your company, what happens? This is one of the benefits of a safe is that you don't really have a maturity date on there. Sometimes you do on a safe too, but generally speaking, maturity date for an investor can be and so it's a potential trap. Okay, is everybody? I'm starting to get some pushback on my internet. If I cut out, I'll come right back in. But is everybody probably good on the conversion events that we're talking about? We're going to mainly focus on the next equity financing piece for the most part. Okay. So early on, we talked about how the investors that are giving you early stage money, they're taking on a ton of risk because you don't have any revenue. You don't have a reliable valuation point. Theoretically, just speak in general terms, it's not always the case. But those investors are taking a lot of risk. And so in order to accommodate their risk and to accommodate, the discount and value of their money that they're giving you today versus a future value, there's these terms that are going to come up in the term sheet called a discount and a valuation cap. And what these two terms do is they say, I give you money today, and we don't know what the company's value is going to be until you establish a value when someone's buying your shares at a price and you have a valuation. But I don't think it's fair to have to pay the same price that those later investors paid because I'm taking on this additional risk. So these terms accommodate that risk. The first one is called the discount. Basically, this is generally between 20 and 30%. I don't really see anything at 30%. It's usually about 20%. It basically says those investors said that your company was worth $1 a share. I'm going to pay 80 cents a share. So I'm going to take my money before. We're going to multiply that times 80 cents and find out how many shares that I get. And that's going to be of the preferred stock that investor is going to get. The valuation cap basically says we're going to cap the valuation that I'm going to convert at. This is one that kind of works a little better in looking at the numbers. But basically it's a cap on the valuation that they're going to pay for with those later, compared to those later investors that are buying at a preferred stock. It's important to note here that the investors don't get both. So they have to choose one, either the discount or the valuation cap, and they're going to choose the one that gives them the cheapest price, gives them the most shares. And you'll kind of catch on when we go to the next slide of how you can tell which one's going to probably be applied. So illustration 1, and let's go back. We're raising money. We've got some convertible debt. We have scaled our company a little bit. We've got some subscribers to our business. We've got some folks who are using our company to buy laundry or to send their laundry across town to get washed and get delivered back. We're starting to get some traction. And so we're going to raise preferred stock now. So we're going to look at this first term right here, fully diluted capitalization. This can be complicated. It can change. So this is basically the stock that's outstanding as of the date that you're issuing the shares. It's all the stock that you and the other founders own, or maybe employees own. the NEF valuation. This is the valuation that the investor that's buying the new shares of stock has valued your company at. I do see the question here about pre-money versus post-money. Yeah, so this is going to come up. I don't want to go into this too much right now, but this is going to change the mechanics of how much dilution you're going to take on, or those investors are going to take on, whether or not the valuation cap is at a pre-money valuation versus post-money. Generally, the safe nowadays that Y Combinator has, I think, is post-money, but it's just kind of a detail to look at. It's not usually not game-changing unless it is. Just lawyers speak for make sure you know whether it's pre-money or post-money. But back to this problem. NEF valuation. So a valuation that investors told us is that the company's worth $4 million. We're going to pretend like this is just pre-money. And then the NEF price, we've got $1 per share. So because we've got the fully diluted capitalization, we've got the valuation there. So we're going to take the valuation and we're going to divide that by the number of shares to know that they're giving us $1 per share. There's kind of the formula there. The term sheet also says they're going to get a discount, and then the valuation cap is going to be 5 million. So just right there, look at kind of the key terms right there. Like the valuation cap is higher than the actual valuation. The discount is 20%. You can probably figure out that's about 80% on the shares. So let's go to the kind of how this works. Next slide there, Bruce. All right, so here's kind of the math that's involved here. If we take the discount, if the investor uses the discount, those early stage investors, they're looking at the discount, they're going to pay 80 cents per share for their original investment. So their original investment is going to give them enough stock that accounts for 80% of share, or 80 cents a share. And that's going to be preferred stock, the same type of stock that those later investors are purchasing. It's just going to be at a discounted price. Or the valuation cap. Well, valuation cap actually is higher than the discount because the valuation cap was higher than the actual valuation. So that's kind of the trick. So the investor is going to use the discount. I guess that right now, and before you can switch over to the next one, Bruce, but I do get asked quite a bit about what's an appropriate valuation cap, and is a valuation cap an evaluation? It's not a valuation, but it kind of, acts as one in a way, in that it limits kind of the upside, or it comes into play a little bit. So it is kind of important. I would say generally companies that are in like biotech or have founders that are proven themselves or have some type of revenue are going to probably be able to push for that $10 million valuation cap a little bit harder. These are just negotiation points. Whereas a company that doesn't have any revenue, doesn't have an experienced founder in the purposes of having sold a company already or having grown or scaled the company already, doesn't have any significant IP, is going to have a harder time getting a $10 million valuation cap. You might be looking at 4. If you're working with an accelerator and that's the early stage investor, it might be 2. It's just kind of a point. And so what I'm trying to get you to understand is how this valuation cap applies and where it comes in. So illustration 2, same type of situation. We've still got 4 million shares. We've got a valuation of $10 million. So we're going to divide 10 by 4 to get our price per share that our new investors are paying. They're paying $2.50 for our shares. Now we're going to kick in. We got the valuation cap and we got the discount. Well, now it should be pretty obvious to us that the valuation cap is going to come in, because those early investors, they said that, hey, we're not going to pay the price per share that's any higher than the valuation cap. So Bruce, you want to show how that works out here? So the discount on the $2.50 is just $2 a share. And the valuation cap, instead of putting that $10 million in there, the actual valuation, we're going to put our valuation cap in there, 5 million, divide that by 4 million, we get $1.25 per share. Since those investors, the early investors, are going to want to pay less to get more shares, their earlier investment amount is going to convert into preferred stock at $1.25 per share. All right. This slide should probably be pushed to later. I don't want to spend a ton of time on this, but one thing that you should be thoughtful of when you are looking at a term sheet from either stage of investment is this concept of knowing what your preferred stock investors are going to get with preferred stock. Like, what is preferred stock? It's stock with a preference, and the preferences are usually pretty standard. And one of the standard preferences is that those preferred stockholders, those preferred stock investors, are going to get a liquidation preference. So that basically means that they are going to get either their money back if the company is sold or the company dissolves, it's liquidated, or they're going to get their ownership percentage back, or a mix of that, or some type of combination or a multiplier of that. So where this comes up and why I'm mentioning this now is that you remember early stage investors, they got theirs at a discount, right? They got their stock, their preferred stock at a cheaper price. So even if those later stage investors paid $1 per share, and they're going to have the right of a liquidation preference that follows $1 per share, those early investors didn't pay $1 per share. So a lot of times it's smart to get out in front of that and to say that when those early stage investors convert to preferred shares, that they're going to get a shadow series of preferred stock. It basically says that you're going to get preferred stock, but your price that you're going to convert at is going to be the actual price that you paid, and you're not going to get this windfall liquidation preference because it matters when there's a huge disparity. Like if I got my shares at 25 cents a share and those investors paid $1 a share, my liquidation preference is just significantly bigger than I actually paid for it. So that's a potential trap. I don't want to spend too much time on it, but shadow preferred is generally the way of doing it. All right. So before we kind of just talked about, I'd say pre-seed and seed funding, convertible instruments. If you have any questions on those, like now is a really good time to ask that, because I'm about to move on to priced equity. And just with the disclaimer that sure, sometimes people sell preferred stock as their first fundraising round. I would generally just say it's less common. It's more of a Series A type of round. I mean, Series A is preferred stock most of the time. And we're going to kind of talk about that because preferred stock is what we call priced equity. It puts some type of valuation on your company. So priced equity. So we're talking Series A here. We have raised our money with our initial investors through our convertible notes. We have grown our business again. We have hired employees. We've brought in a whole team of developers to take our app and to market our app, and we're growing all over the country. We're about to enter some more states. We're going to enter some new countries. We need a lot more money. We need to raise a Series A round. We need to raise $5 million or something like that. So we're going to have to go to venture capital investors. These aren't just angels. They're not just friends and family. These are institutional investors that are getting pitch decks sent to them every single day. And so we want to be the unicorn that they see. We want to have our pitch deck right in front of them, and they are taking on less risk than our earlier investors. And we have a lot more obligations to these investors as far as showing where we've been, like who's on our cap table, what type of convertible notes are outstanding, what type of plans that our founders are on. Do they have restricted stock? Have they transferred their IP over? There's going to be a lot more of sophistication in the diligence side of things. There's going to be a lot more sophistication in the term sheet. So the earlier term sheet had a few bells and whistles, a few negotiation points, maturity date, interest, the type of security, safe versus convertible note, and then the conversion price, which takes into account either the valuation cap or the discount. So relatively speaking, there wasn't a ton of control terms in there. There wasn't things that limited how you run your business, but we're going to start to see those things now when our priced equity round comes in, because those investors are, they're taking on a different type of risk. So the key economic terms we're going to talk about is valuation. We're going to talk about liquidation preference, anti-dilution, and then control and governance terms, board seats and approval rights and covenants. All right, valuation, pre-money versus post-money. Pre-money is the valuation that an investor tells you your company is worth before they give you the money. So if they say, I say your company is worth, I'm going to give you $1 million, and and that's at a pre-money valuation of $4 million. So post-money means $4 million plus a $1 million investment is $5 million. So pre-money versus post-money, it's just backing out from post-money the investment amount to find out what pre-money is. Sometimes when term sheets come out, there's a question of, are they giving me this valuation at pre-money or post-money? It's always wise to just know that that lingo exists. And when you're having an oral conversation with an investor, make sure you clarify whether or not that's post-money or pre-money, because it makes a huge difference. And so that's the big thing. I mean, when you're talking about valuation with preferred stock, the biggest point of view, and there's all these nuances that kind of are tricky to kind of get into or to get into your valuation, whether or not your valuation is going to be with those early investors converting prior to, after, simultaneously with, whether or not you're going to have to reserve stock for employees. Ultimately, all those terms are getting at how much money the investor is going to give you for how much percentage of the company that they're going to have after they give you that money. So generally speaking, again, a Series A preferred investor is going to come up with your valuation by what they are expecting, right? So a lot of Series A investors kind of want like 20%, I'd say, of the company. So they're going to kind of walk that back. I want 20%, so here's a valuation based on that. And it just depends. Basically, there's different type of venture capital investors that invest different types they invest different amounts of money in different types of companies in different stages. Or you're talking about early stage companies, and that tends to be about 20%. So that's valuation. I always get asked, how do you know your valuation? If you can figure that out, you got a better product for you than our delivery, some machine washing, dry cleaning business for sure. So it's not really a science. I mean, if you have some revenues, there's some different ways that you can apply metrics to determine what your company's worth. But at early stage, pre-seed, Series A stage investment, it's a lot of speculation. You might look at a competitor, how much they were able to raise, and basically negotiate off of that. But it's generally just a negotiation point. It's not really a science. Price-based anti-dilution. So this is important for an investor, because a later stage investor, a Series A investor, if you go and they give you $1 million at a valuation, and then later down the road, your company to another investor is actually worth less, they're going to want to protect against that. They're going to want to account for the dilution that's going to happen to them by you giving up more equity at a lower price. So what they're going to want to have is what's called anti-dilution protection. This is different than non-dilution, which I'll go over in a second, but anti-dilution protection basically is a way to measure a down round investment, an investment in which a later round was actually at a lower price, and it counts and gives those investors more shares, allows them to convert into more shares that accounts for that down round. Whether or not how it fluctuates and how advantageous it is for the entrepreneur versus the investor depends on whether it's a weighted average. Broader is better for the founder and the company. Narrower is a little bit worse, and full ratchet's better for the investor. I'm not going to go into this stuff pretty in detail, but just know that it's there. Liquidation preference. We kind of talked about this earlier. When the deal, if the company sold, the company liquidates, what is the investor entitled to get? Are they entitled to get just their investment back, or the proportion of the company that they own? Or do they get their investment back and then the proportion of the sale of the liquidation of the company? So that's participating versus non-participating. Non-participating is the investor has to choose. Participating means that the investor basically gets their cake and they get to eat it too. So I'm going to I think there's an example here on how this works. let's say it was a $1 million investment for 20% of the company sells for 4 million. Non-participating, the investor just gets 1 times their money back. The investor is going to choose to do that instead of the 20% that they own, because that's more. They get 1 million in that situation. If they're participating, they get their 1 million back, and then they get their proportion from the sale. So you're going to back out that 1 million. You got 3 million. They're going to get 20% of the remaining 3 million there. Control terms. So remember, our early stage investors, friends and family, angels, they don't want to deal with this. It's a passive investment. Sometimes it's more they're investing in you as opposed to your idea. They're not in the business of growing companies. They might just be wealthy individuals. There might be somebody who wants to, give you something as a part of your inheritance and invest in you. And so they're not going to have these control terms. Like, they're basically taking a risk for a high payout. It's a risky investment from their perspective. But venture capital investment, once you're getting a Series A investment, the company has proven something. It knows that we have a valuation that somebody was willing to give for its shares. And there's going to be some non-economic terms there that an investor is going to want to protect the economics of their investment. And so these terms generally mean of whether or not an investor is going to want to have a board seat or whether they're just going to have a passive role. Generally, at a Series A preferred stock investment, especially when substantial money's on the table, they're going to get 1 board seat, maybe 2, depending on how big the board is. I think that's something that is really important to know too when you're a founder. What is this? Like, what's the difference between your rights and your leverage as a shareholder or stockholder versus your leverage and your ability to act as a board member and an officer. So knowing those different distinctions of hats that you wear are important. They start to become very important here because generally stockholders, they appoint the board and the board appoints the officers. So once these investors start coming in with preferred stock, they get a lot of control over who's on the board, what the board can do, and what those other shareholders can do. Generally, they're going to get a right to get an okay right to make big changes. And so it's really important at this stage of the game to have control of the board. And so that those investors are going to want to have some type of board role, and they're going to want one of their board members from one of their venture capital firms to sign off on things before they're done. So approval rights, these are what we kind of talked about, major changes, selling the company. The VC is going to want a big role in that, giving more shares out, giving high compensation to a CEO, spinning out some of your IP, just major things that impact the investment. They're going to want some type of veto or thumbs up into those types of transactions. Covenants, these are kind of the two sides of the same coin of approval rights. They're just promises. They're promises by the company of what it's going to do and not going to do. So it's going to promise that it's going to make all of its employees assign their IP over to the company, right? Because if I have developers who are creating my app and they don't assign my company the IP rights to that, then they're going to own the IP rights to it. And my company could be a lot less valuable if a key part of my code to my app is actually owned by some rogue employee or potentially a developer in another country. So we're going to make sure that those things are all tied up. And that's a part of a covenant, a promise the company makes to do. Inspection rights, these are basically rights that the investor is going to get to have to look at like the books and records, to see the meeting minutes, to see what's going on under the hood. Generally at this stage, you're not getting, a ton of, pushback on having an independent accountant certify the financials, but they're going to have access to the books and records. I think there's something in the chat here. Yeah, exactly. The term sheet's going to be a mix of economic and non-economic terms. The stage of investment is going to dictate that. Again, the early stage, the convertible note stage, I like to call it, is not going to have any economic terms in it really, or not going to have any non-economic terms in there really, but you're going to see a lot more non-economic terms and a lot bigger of a term sheet in your Series A preferred stock round. Miscellaneous things. Preemptive rights, right of first refusal. This basically says that in the event that the company is going to issue, sometimes called a pay-to-play provision as well. Basically, those investors, and this might happen at any stage, those investors might say, if you're going to raise more money, I want the right to participate next. And so kind of whether or not you're going to negotiate that point, you need to have a little bit of foresight on it. I mean, it sounds ridiculously rude to tell an investor, I don't want to let you participate in the future, but sometimes, you might not want your Aunt Kathy to stay on and have a significant role and to keep owning a high percentage of the company because she, might be difficult to deal with. So you got to kind of have a little bit of foresight on whether or not you're gonna push or pull on that. Most favored nations, basically, you're not gonna sell your shares at a lesser price. You're gonna give us just as good as terms as everybody else. The don't do's, non-dilution. You see this, and when folks try to raise money themselves, and it can kill a business. So somebody wants to give you $250,000 and they're going to get common stock. And then they've got in their agreement that they're never going to be diluted past, 5% or 25% or something crazy. And then you go to raise money down the road, and no investor is going to want to come in when some person who is just a passive investor is always going to get the right to maintain their 25% ownership. I mean, that gives little room for new investors. It gives little incentive for the founders to kind of keep growing the business because they're going to be diluted. It completely shuts down your company if this happens. Non-dilution provision, you should never accept that. You just shouldn't, unless you absolutely need it. I still wouldn't justify it. Mandatory dividends at the stages we're talking about. Generally, mandatory dividends are pretty ridiculous. You're basically taking investor money and paying them with their own money. I mean, they're being taxed on that. It doesn't make any sense. So mandatory dividends are for later stage, like Series C, maybe Series B. It's just not normally in the cards for Series A, and definitely not anything before that. Redemption or put rights. These are things that require the company to buy the shares back. You might see this in Series A. I would avoid it. You should definitely not see this in anything earlier than that. There needs to be significant money on the table in order for those rights to be kind of granted. So I saw a question in the chat here. It's Matt. Let's see.
If you could read it out too, Shane.
Yeah, sorry. At what point in the process would a third-party CPA account audit be expected? I mean, I think if you're raising a Series A round, a substantial amount of money, and the company is generating a substantial amount of revenue, then you might get that pushback of like actually certifying your financials. It's not really like a standard time and place to do it. But it just kind of depends on your business. I mean, a lot of times these companies don't even have any revenue. It's more of just like the profit and loss statement's just loss. So, there's not really that much of a push for it. I'd say later stage, more likely. I don't know how I did on time. I think I might have cruised pretty quickly through that. So
yeah, no, you were great on time, Shane. That was perfect. We got about 10 minutes now for questions, which is awesome. I mean, I know that, the control terms in particular can be very scary. There's a lot of terminology. Shane, do you know of any great resources where someone could read up on half of the different control terms or the terminologies that can be thrown into a term sheet?
Yeah. So when I first started a couple of years back as an attorney, doing private equity transactions, capital raising, M&A, attorney gave me this book called Venture Deals, and that was like everything you could. I think it's pitched as, there it is right there, no more than your venture capitalist and your lawyer. I mean, it's just the holy grail for venture. I mean, it's a lot to deal with. It's not a light read at all. I mean, it's definitely easier than reading the documents, I'd say, like reading a term sheet or reading like a stock purchase agreement. But if you read that once, you'll be smarter than everybody else you're dealing with. If you read it twice.
Not a great one for Audible, I have to say. It's not great for Audible.
Yeah, I that would be difficult because they have the formulas in there and everything too. Oh yeah, it's definitely not an Audible book. That's the best source. I mean, to plug my own stuff, go our blog. I mean, I talk about venture financing all the time. I have like a blog on this exact same thing, a term sheet with some examples. You can back the math out. Control terms. I mean, I don't really write about that as much. The early stage stuff, probably shouldn't be seeing a ton of control terms, but I think the venture deals, knowing kind of what the term names are, like knowing what a right of first refusal is, like basically I get the right to buy something before you can sell it to someone else. Kind of think of that in terms of like if you have right of first refusal on selling your house to your neighbor, knowing what preemptive rights are, just kind of knowing the terms, kind of probably go a long way.
I'm glad you mentioned not signing personal guarantees. Obviously, that's super important, but obviously, it's called Shark Tank for a reason, right? Can you tell us some other kind of red flag control terms that you should really pay attention for? That you should be like, whoa, that's a signal. I should not be playing with this person.
Yeah, I mean, personal guarantee is just not doable. Let's see. The right about maybe like some type of involvement on like what the salary is of like the CEO. I mean, if someone's trying to see, this is all relatively speaking, but generally, if you're a startup, you're raising a couple $100,000 in your initial capital. The CEO is not seeing a six-figure check. Like they're eating ramen and they're probably might even have another job. And so any investors that's going to come in and mandate that is probably a red flag. That's like they don't really know what they're getting into, and they might have higher expectations that like the company's even going to have enough revenue to pay a founder an absurd salary. That's kind of maybe a hidden red flag. I mean, anti-dilution, maintaining your same percentages without paying more money is a huge red flag. A board seat on a convertible note is another huge red flag. It just depends on the stage. That before Series A, you shouldn't really see any control terms other than I'm not going to transfer my IP out of the company into another company that I own.
Thank you for that. Looks like you got 2 questions in the chat. If you don't mind reading those out.
Everything you see on Twitter, online media, people are talking about how much capital is out there right now, and people are investing like crazy. Is that more towards the VCs and Series A? Are you seeing a lot of capital getting thrown around seed rounds as well? So I'll give you my personal take on this. There's different things that are going on right now. Like there is crowdfunding, which is a whole other side of venture financing. And I could talk about that and kind of try to convince you not to do it another time. But I think the markets right now are just wild, right? Like it's just a very volatile market, and it kind of makes venture investing seem less volatile. And if you look at kind of the exits for Airbnb a couple months ago, I think it was probably like August, maybe September. I mean, their valuation was like $46 billion. I mean, could you imagine if you gave $100,000 safe note in Airbnb at the very beginning? I mean, you'd be a millionaire easily. And so I think that the media is starting to catch on to it a little bit more now of what venture investing is. Obviously, venture capital investing is expanding. It's kind of changing still. A great source is PitchBook. Go to Google PitchBook. They have reports every year, like 2020 report on venture financing. It can tell you where the market's gone, like how many more venture capitalists are out there, how many more angel investors are out there now, where the money's going, like what states, what types of industries. Is a great source for it. I think generally speaking, this industry is growing. People didn't think it could grow any more than 2015. It's growing even more. There's a lot more industries like ag tech that are kind of emerging. And so I think, I don't think it's going to go anywhere. I think that there is a lot of capital out there. I think people are a little more sophisticated as we've kind of become attuned to this from an angel investor perspective. They can find out what a safe is. They can see Y Combinator does them. They can download it offline. I think there's a lot more knowledge in the market, so you're going to see a lot more people involved in it. What are common terms in this region? So in the Southeast, I'd say, and Kentucky, I would loop in the Southeast, I would say that you're probably going to see convertible notes a lot more. You're probably also going to be approached with just debt. I don't think that makes any sense if I were an investor to just give you debt, because you might just go belly up, or there's not really that upside there. I think you're going to probably get a little bit more pushback on a safe in this region, as opposed to some other regions. Just generally speaking, I think that your valuation cap will probably be a little bit lower. And people might argue with you and say that's a valuation. It's not. It's just a cap on your future valuation. So try to use that little lawyerly lingo there. But yeah, I think that the terms are generally going to stay the same. Now, the person you're dealing with might not have a lot of venture capital experience, and so that might change, the fundamental understanding of it, but the term shouldn't change substantially. Crowdfunding increased to 5 million if you do.
I was pointing out, adding to Chris's point when you mentioned crowdfunding, that in January, I believe they increased the amount of crowdfunding ability to 5 million. That was a new SEC change for this year, for 2021.
Right,
There's
yeah.
another question from Natalia that says, when and do you register Series A with the SEC?
So this is really complex, but you don't, so generally speaking, every sale of security, what a security is, it includes like coins, like utility coins from like the blockchain, and it includes like stock, and it includes safes, it includes membership interest in an LLC. Everything you should basically say is a security. It needs to, the sale or the issuance of, or the offer of securities either needs to be registered with the SEC or it needs to be exempt. And so that's the general rule, but sometimes the exemption swallows the rule. And this is one of those situations where if your investors are accredited investors, which mean that they're wealthy, right? They've, together with their spouse, make over $300,000 a year, expect to have the same, over $1 million in assets minus their house. They're going to be accredited investors. And so they're going to be able to fend for themselves. And so they're going to be covered under an exemption, most likely, to registration. So you don't register the securities with the SEC. Instead, you file a Form D, which is a notice filing that tells the SEC, hey, I'm offering securities under an exemption, and I'm telling you that I'm doing it, and I'm going to comply with the different rules on exemptions and what I need to do. And a lot of times that's state fulfillments that you need to do. Every state kind of has a little bit different rule depending on the exemption you're relying on. But you don't register it, but you do have to do a notice filing. You have to do a notice filing within 15 days of entering into agreement to accept money or accepting money, whatever's earlier. So you need to be cognizant of that, and you need to even just soliciting and asking people for money in exchange for investing in your company is governed by the SEC. So you shouldn't do that at all, especially like on social media and stuff where it's easily trackable. But when you generally speaking, you get a little bit more leeway when you're dealing with accredited investors. And so that's one of the things that you initially ask someone, is you have them certify they're accredited investor. And the idea is, I don't want to take up too much time on this, but the idea is that the SEC laws were designed to protect, quote unquote, widows and orphans, right? So the SEC wants to protect against fraudulent activity. And the history of it's really interesting. States had blue sky laws because people were selling blue skies, like fraudulent companies were selling securities to widows and orphans for the promise of blue skies. And so that's kind of where we have the SEC regulation come in, is protecting widows and orphans. And, that's kind of changed a little bit nowadays. So I think I'm at time. If anybody has any questions, there's some interesting stuff going on right now in securities world. One thing that I think is important for folks in kind of this region to know about is the new exemption for finders. It's been pushed through with the SEC. The SEC, basically, people who help you raise money are likely broker dealers, and they're subject to regulation. But like in this area where you don't know these investors, you can't just like cold call them. if you know somebody who's connected and can make an introduction, like a lot of times it's like good because there's just a discrepancy where we're not all in Silicon Valley where, you know, these are just so accessible. Like you kind of have to go through somebody else. And sometimes that other person's actually doing a lot of work to help you do it. And so the SEC is kind of looking at whether now they want to allow these finders to be able to get paid to help you raise money as long as they fall within this little safe harbor rules on what you kind of can't do. And it's not official yet, but you know, in October of last year, they did propose to exempt that type of activity. Nothing's been formalized yet, but take a look at our blog too. That's kind of on there, what that means. I think for this region, it's going to be really important. I'm for it. I understand that, you know, widows and orphans need to be protected, but it's helpful. I think it takes somebody who is an entrepreneur who's been successful and allows them to make introductions. And I think it's good for startups.
Great point, Shane. And yeah, always, we're glad to have people like you that are staying up to date on this kind of information to really keep us informed and keep us on top of our game. So that was perfect. I'm gonna go ahead and hit stop on the